Everybody is lying to you. Everybody tells you that the inflation rate is only at 3.1, 3.2% per annum over the decades. That's apparently how quickly money devalues. But really, the monetary base expands by 6.8% per annum, much faster than the official numbers. And that's a problem because most investments are not able to return 6.8% per annum. Now, why are the official numbers lower? Of course, there's a conflict of interest here. The government wants us to believe that the currency is stable, but also because we've got technological progress, right? It becomes easier and easier to produce those consumer goods over time. And that technological progress is not inherent in those inflation numbers. If we become better at producing something by, say, 3% per annum, then those things should actually become cheaper by 3% every single year. But if the monetary base expands by 6.8%, there we have it. The thing actually gets more expensive by 3% roughly. Now that's then a challenge. This monetary devaluation is a challenge, but this challenge is solvable. For example, here we've got the Nasdaq 100 relative to the money supply. So this now measures US technology stocks relative to the debasement. And over the decades, this is going up. Yes, we had our .com bubble burst and subsequently the global financial crisis. So from top to bottom, we had temporarily a drop of 87%. But if you've got a time horizon that's 20 or 30 years, you should be okay. From this top here, the year 2000, to the day when we reclaimed those valuations, measured in the US money supply, it took 25 years. So that's the worst case. But we could also take the average case. So over here, when we went sideways, that's from 1997 to 2013. So 16 years of data. Still, it can take a very long time until we get our purchasing power back. But very long term, we tend to outperform. Now, investing is a game of opportunity cost. And obviously, parking our money in fiat currency is not really an opportunity. Again, because of the devaluation of 6.8% per annum. We have to put our money somewhere, be this in property, be this in gold, be this in stocks. And apparently, technology stocks are the better option. At least within the stock market. Check this out. This is the Nasdaq 100 relative to the S&P 500. So technology stocks in relation to all the other stocks in the US. We've got our .com bubble, but over the decades, this tends to outperform fairly consistently. And so if we diversify across asset classes, right, if we own some stocks, some property, some precious metals, maybe some crypto, if we have our stock allocation and stocks tend to move in the same direction at the same time, we might as well just get into the technology stocks if our time horizon is long enough. They tended to perform better. Hi, my name is Gerhard. I've been in the investment game for the last 8 years. I hit my first million 3 years ago. And in this video, I want to share my personal approaches, how I allocate across asset classes and how I'm able to beat my general benchmarks, which is the stock market, which is Bitcoin. And it is through active investing, not just through passive allocations. If you're interested in how I do this, feel free to check out my track record. That's public on the website. It's also linked down below. All my trades are logged. All my trades are shown with their entry and exit with the individual messages, 100% transparent. And I don't think there are many investment channels that are actually willing to share all of that data. I'm of course not sharing my currently open positions here directly on YouTube. That's available for the premium members. Now back to the concept of investing in technology stocks rather than just the general stock market. We can actually refine this a bit more. Have a look at this comparison. This is the S&P 1 versus the S&P 500. So what does this mean? The S&P 1 is simply the largest stock in the US market at any point in time. So we're not buying the top 500 stocks, we're just buying the largest. And we hold this for the year. And then at the beginning of the year, we again look at what is currently the largest stock and then we buy that. So in the early days, this was General Electric, then it changed to ExxonMobil, then it became Apple. Today, it is Nvidia. So that's the S&P 1, that's in blue. The S&P 500, that's the line in orange. This is on a linear scale. Let's have a look at the same on a logarithmic scale. The outperformance is quite consistent. How consistent? Check this out. So we've got the S&P 1 in blue again. We've got the S&P 500 in orange. This is now the yearly performance. Let's have a look at the delta. And that's that. Yes, there are some years where the S&P 1, so the largest asset, underperforms the S&P 500, but it's clearly in the minority. Now here's the S&P 2, and here is the relative performance year over year. I think the S&P 2 seems to be even more consistent in its outperformance compared to the S&P 1. So here's again S&P 1, here is S&P 2. What are we doing with the S&P 2? We simply hold the two largest stocks based on their market cap weights. So right now that would be Nvidia with 53% and Apple with 47%. And again, we simply just hold the top two stocks based on their market caps. We just rebalance once a year. This is not too much of a problem in terms of management. Check out the S&P 3 and its outperformance, and that's personally my favorite. Again, S&P 1 versus S&P 2 versus S&P 3. S&P 3, especially in the recent years, tended to outperform the most. And what does this mean today? It means we are holding Nvidia, Apple, and Google. Now this tells a very similar story to this chart here, right? The Nasdaq 100 relative to the S&P 500. But it is a bit more refined, as in we are not just betting on technology. We are just betting on the sector of the economy that's currently dominant. Maybe in a few years, this will not be technology anymore. During this backtest here, which starts in 1990, it was definitely not technology all the time. We did have things like Pfizer in here or ExxonMobil. Check out this overview here. We've got the S&P 500 at the top. We've got the S&P 1, S&P 2, S&P 3, and we've got their weighted annual growth rate. We've got the alpha versus buying and holding the S&P 500. We've got the total return, and we've also got the volatility. And of course, our volatility is higher when we only own 3 stocks versus 500 stocks. But is this additional volatility worth it, given that the growth rate is so much larger? The volatility is 25% per annum for the S&P 3 versus only 17% per annum for the S&P 500. But the delta in performance is massive, 10.5% versus 17.7%. This is the same data just in a chart. So we've got the growth rate in blue, we've got the volatility in orange, and we've got the maximum drawdown in red. And at the bottom, we see what kind of S&P we have. So the S&P 500 on the very left, the S&P 1, 2, 3, 4, 5, etc. We see how this changes the more we diversify. But really, the volatility doesn't even decrease that much as we go up with the number of assets. We really have to own all 500 assets in order to reduce our volatility a little bit. But again, this reduces our return massively. And we can already see this here on this linear chart, but actually where it becomes tangible is when we look at the actual numbers. Check this out. If you invested $100 in the S&P 500 in the year 1990, you would now have $4,000. Not too bad, but of course there is monetary debasement. If you invested those $100 though in the S&P 3, so just the top 3 assets in the S&P 500, you'd have more than 10 times that amount. Instead of $4,000, you'd have $42,000. That's what's the difference of just 7 percentage points per annum, because it compounds, and compounding is a big thing, especially when we consider that 6.8% of the S&P 500's return is just monetary debasement. There is real alpha here. People underestimate how important it is to invest in the right things. And who came up with this idea that holding 500 stocks is the ideal? Why should we hold 500 stocks? Why not 100? Why not 200? Why not 3? Historically, 3 stocks had been the best. Yes, it is more risky, but mathematically, that risk was definitely worth it. If technology suddenly does not perform that well anymore, if the AI bubble was to suddenly pop, then probably the top 3 stocks are not Nvidia, Apple, and Google anymore. And they're probably going to rotate, and then we will own those new things. So with this strategy, we've got an outperformance of a bit over 7%, right? 7.3%. Is that the same compared to the outperformance of holding the Nasdaq 100 relative to the S&P 500? The answer is no. The outperformance of owning the top 3 stocks is actually higher compared to just holding tech stocks versus the general stock market. Let me show you what I mean. We've got here 2 data points, 2013 and 2023, so 10 years of data. During that time period, the Nasdaq 100 outperformed regular stocks by roughly 62%. If we annualize that, then we get an alpha of 5% per per annum. So technology stocks on average outperform regular stocks by 5% per annum. But the top 3 stocks relative to the top 500 stocks, they outperform by more than that. Not just 5%, but 7.3%. In other words, this is not a story of technology stocks versus regular stocks. It's really a story of concentration, of capital concentration. It is a winner takes most market. And this makes intuitively 100% sense. Because let's say you're working hard. Let's say you've got awesome grades from university. Let's say you're super skilled. Who are you going to work for? Of course, you're going to work for the market leader. And so the market leader attracts the best talent. The best talent is going to compound the returns of the monopoly. And so profits are going to aggregate more and more towards that monopoly, until we've got over-investment and then things turn around. But usually the default is that the winner keeps on winning and the loser has to take the second tier and keeps on, relatively speaking, losing. Why do we want to own stock number 499, where nobody wants to work for that company, where nobody has heard of that name, where we can also invest into Nvidia that has a moat, where nobody can compete, and where the brightest minds of our time are getting employed, are working hard and make more money. I hope you're getting some value out of this video. If you did, feel free to subscribe. I publish videos regularly. A like would be very much appreciated as well. Feel free to also check out the premium membership. This is where I share what kind of trades I do. This is also where you can watch a lot of tutorials where I share my approaches. Where I also share how to do some backtests to figure out how the market is really working. That's content that mass media will never teach you. It's the content that actually makes money long term. Thanks for watching and see you next time. Cheers.